So this is chapter 13. We're going to issue some stock at par, at premium. You can kind of see what that looks like. So the first one is we have two classes of stock: common, which has a $3 par value, and preferred, which has a $30 par value. So let's go ahead and issue the first one of 4,500 shares of common stock for $6 per share. What I want to do first is I want to figure out how much in cash I'm getting. So if I issued $4,500, or excuse me, 4,500 shares at $6 a share, I'm getting $2,700 in cash. My common stock would be the 4,500 times my par value. And then we have additional paid-in capital. And that's just going to be the difference. So I have additional paid-in capital of $13,500 as well. So the second one tells us how much in cash we received, but it doesn't tell us what we sold it for. So I'm going to go about it the same way. I'm going to record my cash. So I received $135,000. I'm going to go ahead and say this is my preferred stock. And that was $4,500 at $30 a share. And so really there was no additional paid-in capital. We issued the stock for what our par value was. So there's nothing else that we need to do in that case. Okay. The next one I want to do is some treasury stock. So in this example, on December 1st, we purchased 1,900 shares of the company's par value, dollar par value common stock as treasury stock, paying cash of $5 per share. So let me go ahead and make the credit entry first because we have cash going out the door. We paid $5 a share and it was 1,900 shares. And then I'm just going to hit my treasury stock. So we don't care about the par value. It means nothing at this point. So we have 9,500 treasury stock and 9,500 that went out the door in cash. Now I'm going to put the little $5 over here because I know I'm going to need that later. So in this case, we sold 200 shares of the treasury stock at $8 per share. So let's see how much cash we're getting. So we are receiving 200 shares times $8 a share, 1,600. And then I'm going to do treasury stock. And I am going to account for that at what I purchased it back for, so my $5 a share. So I sold 200 at the $5 that I bought it for. And then my additional paid-in capital, again, is going to be the difference. Okay, so then we sold 1,000 shares of treasury stock for cash of $1 per share. And we're going to talk about this balance in a minute. So we sold, let's calculate our cash. It was 1,000 shares at $1 per share, so $1,000 is what we received. So my treasury stock is going to be $5 times the 1,000. So first of all, we sold this stock for more than we bought it for, or excuse me, for less than we bought it for, which is a problem. We bought it for $5 a share. We're turning around and selling it for $1 a share. So we must really, really need the cash. Now, typically what you would do is you would lower your paid-in capital. Now, we are short $4,000. What you can see here is that we only have $2,400 in our paid-in capital account. So let's go ahead and get rid of all of that. And we can't go below that, we just don't have it. So what we're going to have to do is we're going to have to lower our retained earnings directly. And that's never a good idea, but we don't have a choice in this case. So I'm going to have to lower it by $1,600 so that our journal entries balance here. So if I end up selling my treasury stock for less than what I bought it for, first, I'm going to lower my paid-in capital, and hopefully you have more paid-in capital than what you have to lower it by. If you don't, then you have to lower your retained earnings by the difference. Okay, so let's talk about dividends. We earned a net income of $85,000 during the year. On December 15th, we declared an annual cash dividend of 4% of preferred stock and 25 cents per share on cash dividends on common stock. And then we paid it on January 4th. So there are 3 dates that we're worried about. One is when we declare it, that's when we incur the liability. And then what we do is on the second date, we go ahead and see who owns that stock as of a certain date. There's no journal entry for that. And then the last date is the January 4th when we actually pay it. So let's figure out what our liability is going to be. So the date that we declare it is December 15th. That's the date that we have now incurred our liability. So we declare an annual cash dividend on 4% of preferred stock. So does it say what our preferred stock is? Yeah, so we have par value of $120,000. So let's go ahead and calculate our liability. So I'll go ahead and make the bottom entry first. So we have dividends payable, and that's going to be 120,000 times 4%. And then I'm going to lower my retained earnings directly because it's not an expense to pay dividends. It just lowers your retained earnings. So then when I pay it on January 4th, I'm going to go ahead and get rid of my dividends payable of $4,800, and I have cash going out the door of $4,800. So that's for my preferred stock. Now the next part talks about 25 cents per share cash dividend on common stock, and there's 50,000 shares. Let's go ahead and do that. So 12.15, we are going to lower our retained earnings, and it's going to be 50,000 times our 25 cents. So it's going to be 12,500. We have dividends payable, 12,500. And then again on January 4th, we're going to lower our dividends payable and increase our cash. Excuse me, decrease our cash. Okay, so that's a cash dividend.